G'day expats and welcome to episode 22 of Expat Chat and kicking off the first episode for 2021. G'day James.
G'day, Brett. Happy New Year. Can't wait to get stuck in it. We've got a big year planned for expats and obviously kickstarting it with this episode. Obviously, if we reflect back on 2020, what a crazy year. And I mean, it's only been, 3-4 weeks into January and look at what's been happening over in the US.
We've got a guy walk around with horns in the Capitol building. Who'd have thought we'd see that?
Oh my gosh. I mean, we knew the US last year was a circus and obviously first 3 weeks haven't been much better, but it looks like there's been now that smooth transition and Biden administration has kickstarted.
It has, and I was just, pontificating on, how quick the last year's gone. And this time last year, you were actually in Dubai with me.
That's right.
We were running some seminars for expats here and also participating in the raising of donations for the bushfires.
That's right. I think there was that Australia Day event down at, I can't remember.
Zero Gravity.
The name of the, that's right, Zero Gravity. I suppose I was a bit shocked by the temperatures, given it was
You froze.
Dubai. I think we're down on the beach there. It was 14 degrees, and I didn't pack any warm gear at all. I mean, who does that?
No, not here. But it is amazing, isn't it? What's transpired over the last 12 months. If you said to anyone this time last year, you're going to go through, and even just said half of what we're going to go through, you'd be locked up in the funny farm. Whereas, I think people need to give themselves some credit and credit where it's due. We've all done a pretty good job in emotionally and financially getting ourselves through the last 12 months. Unfortunately, there's some very sad cases of people losing their jobs, and jobs have held for many, many years. But right. It's been one of those scenarios where, as a group, as humanity, we've all been tested, and we're still standing.
That's right. I think, as we knew last year, one consistency was just how much uncertainty there was, but, we will get through. We will obviously keep grinding away and we'll still come out the other side. And I think obviously 2021 is part of that coming out the other side. I mean, it's still not going to be an easy year. It's going to be a better year. Obviously the vaccine programs have started to come out. Speaking of which, I think you're booked in next month, aren't you, to get your vaccine?
Mate, I've already had the first jab. And getting the second jab on the 12th of February. So it's the way Dubai's dealing with this is, in order to try and keep the country open, let's go for a massive vaccination roll. And I think there's 120 centres throughout the UAE where to get vaccinated.
Oh wow, that's huge.
So it's amazing. They've done a great job in getting this done. So that's their way of combating it. Everyone knows. Especially with this UK strain and the South African strain. Sorry, I almost called it South Australian strain. Sorry for those from Adelaide.
Radelaide, I think.
Radelaide. But that's the way they're coping with it. And, no side effects so far, which is good. So,
They always say with those vaccines, the second shot's what usually takes its little toll.
Yeah, exactly. And then once we get the second one done, then 28 days after that, get an antibody test just to make sure that the vaccine's doing its job. And, it's, I think, from a peace of mind point of view, it is a bit of a weight off your shoulders. You don't realise how much you're worried about it until you get that first jab and think, okay, I feel a bit more relaxed now because half the job's done, sort of thing.
Yeah, speaking of which, I mean, when you had the jab, the next day, did you feel anything?
Nothing.
Did you feel quite normal? Nothing.
No arm was a bit sore that night, but next day, you never know. You never know. I had the jab the day before, so from that point of view, pretty thankful. Some get a little bit of a fever, some get a bit of nausea, some get a bit of fatigue, but nothing for myself, which is great. So
well, you see in Australia, I think they wanted to try and. They had that special national cabinet meeting, I think 2 weeks ago on a Friday, talking about, we'll try and roll this out mid-February, but now it looks like
March.
The vaccine rollout program's been stalled again in March. But I guess, realistically, when you look at Australia, our daily active cases, we are so low. We've been doing such a great job, and it would just be great if the borders sort of reopened and they were a bit more flexible in that regard and the self-quarantining rules. But I think, obviously, later in the year, once vaccines have rolled out, the biggest challenge for obviously a lot of countries is, having developed policies and procedures about, okay, if you've had this vaccine, you're allowed in, you get a test on arrival, PCR test like you've been doing in the UAE or whatever it might be, and then off you go. It's going to be interesting to see how they develop that system, especially with passports and all those sort of things. You think it would be linked to your passport?
Yeah, looking at a client sent me a link to the Emirates website, has their travel updates, and Mauritius have already come out and said if you have Sinopharm, Pfizer, Medina or AstraZeneca, you can come in. So it's already happening, but you need to take a certificate. But I know here they're trialling with IATA, the International Air Transport Association, of actually having an app where it's linked to the local health provider. So you actually carry around on an app on your phone your digital certificate just to show that you've been vaccinated. So that's to me, I wouldn't even know where to get a certificate to say that I got the jab. So I wouldn't have a clue. So
that makes sense. That's your digital entry card to a country. There you go.
Exactly. Yeah, I mean, I can show someone on my phone that I got the jab, but they could look at that and go, I don't know what I'm looking at. So they need some sort of standardized
universal.
Universal type of a platform where everyone recognizes, if you're using that, then it's fine. So, but it's certainly going to be an interesting one. I think, this time next year when we do another one of these episodes, I think we'll be talking about just as much change. I think we'll see, to me, 2021 is a new chapter. I don't think it's the end chapter in the book, but it's a new chapter. 2020 is put behind us. And, it'd be nice to see where companies go with being more progressive with how they're coping with, COVID and those sort of things. So it's looking here, they're bringing in, rules to try and quell gatherings, I guess you could say.
Yeah.
Clearly that's the way that, it spreads. But that you can tell they don't want to close the place down. So that's finding that balance between the two, and it's interesting watching what everyone else is doing from afar to say, okay, that's what's going on, that's what's going on. So,
you look at 2020 and you look at just the whole work from home concepts, the ability to adapt, and so many businesses that have now gone online, which, 2019 you never thought could, and now they are. So it's 2021 might be another one of those years where businesses keep adapting and new concepts come out, with not necessarily working from home but something else. It's exciting. It's forcing us to adapt.
And look, I think it's bringing forward technology. I think we're not seeing it yet, but I do think in the next year or two, because of the widespread adoption of technology in business now, it's going to foster a lot more developments in terms of R&D and that sort of stuff over the coming years. So I think it will just escalate and be like an exponential curve.
Yeah, absolutely. And I think, I'll tie us back to probably today's agenda actually, but before we move on and kick into it, a general disclaimer.
Disclaimer, all entertainment that you see and hear and buy is for your general purposes only, and it should not be construed as personal financial advice.
That's right. Entertainment use only.
Yes, entertainment use only. Good heads for radio.
That's right. Well, I mean, we'll jump into it. I think, first of all, I'd love to pick your brain, Brett, a bit about, how the market's been tracking, I suppose what we might see 2021, as well as property as well. And then I suppose I want to discuss some general themes, especially what I've been seeing in the last probably 3 or 4 months with just expats or repats. And then, we'll wind it up at the end of that.
Sounds good. Now, look, on the market front, property-wise, the Australian market's been following suit with a lot of other markets around the world, including the UK. It has been, providing a lot of resilience. In saying that, I don't think we've got to that inflection point yet for property in terms of reflecting what's going on. And the reason I say that is when you look at those who are holding property, even if you lost your job, even if your tenant wasn't paying, you had support. But that stops in March. So there's a great saying, when the tide goes out, you see you swimming naked. And to me, the biggest thing that I look at, and we always talk about it now in our webinars and seminars and those sort of things, we don't read papers to get feedback in terms of what's going on in the real world. We use sources like the Australian Bureau of Stats when they release their ABS chart pack. And the scary thing to me is in February and January, of last year. So before COVID even sort of swept through the economy and shutdowns were enforced, and we were all living a normal life, and this thing was in Wuhan, China, and what's going on. Defaults on Australian mortgages at 1.5 times the peak of the GFC.
Yep.
So before it even kicked off. Now, going to March, April, May, June, obviously repayment holidays, all those things are going on. But believe it or not, now up until September last year, defaults are now 2.5 times they were back in February. So even with repayment holidays, even with rent eviction moratoriums, all that support, even with JobKeeper, defaults have still gone up, which tells me that default process it takes a year or two to happen. So what we're seeing in September was actually from the year before in terms of the bank saying, please repay your loan, please repay your loan. Now we've got to repossess. Now we've got to do it. That takes a lot of time. So in actual fact, all's not good in the hood for Australian property owners. And what we'll do is we'll put in the description the link to the Australian the chart pack anyway, so people can see for themselves. Personal loan default gone through the roof as well. So I just think there's a bit more to play out here.
Yeah, absolutely. And I think when we conducted one of those webinars last year, when you look at sort of the total loans that are being taken out, especially in the last sort of 2 to 3 years, it was a case where I think investors had really left the building. I think,
they haven't been there since 2018.
Yeah, exactly right. So it's going to be interesting. And you're right, we probably won't really see that real hard data about defaults probably until later in the year. I mean, as you referred to before, at the end of March, JobKeeper payments rolling back to nil. Obviously a lot of small businesses have been surviving off these. I know, reflect on the hospitality industry in Australia alone, all the cafes, Melbourne, Sydney, Brisbane, Gold Coast, over in Perth. A lot of those businesses, they will go bust because they have been relying on these JobKeeper payments. And, that's been $750 a fortnight or maybe more actually. So once they pull the pin on that, if obviously they're not at full capacity from a revenue point of view or, as busy as what they have been, really going to struggle. And then that's going to feed onto, okay, well, how can that business owner release capital? Next step, let's look at my assets, property. I can't really access super anymore because they pulled the pin on that. So next best thing is property. So it'll be interesting, very interesting.
And the problem with a lot of those businesses, they control a lot of hard assets. In hospitality, you've got a premises. It's not like you just wind back all your expenses. You've got lease payments. You've got, payments on equipment. There's all that sort of stuff as well. They find very difficult to wind back. So to me, look, unfortunately, I think, April's going to be a very sobering month when it comes to seeing the lay of the land because at that point, there is no support.
That's right. And I think when you and I were talking about sort of just, what the share market might do locally, I mean, I think Australian shares, they're poised to have an all right year, but I guess, we are sort of also going to be hindered by Big Brother being the US. What's happening in the US, you look at sort of the US share market, how it's performed over the last 13 months. It somewhat doesn't really make sense, to be honest. I think I was looking at Tesla's PE ratio last week. I think the industry average for American motor vehicles over there, I think it's 15.3, and then Tesla's was 135. So
it was an interesting one. I went through and looked at some research over the holidays, and Morningstar did a great research piece where they went and looked at the book value of a company in a similar sort of at a similar age. So Tesla's 8 years old. So they went back and looked at Apple, Google, which is Alphabet, and one more, which might be Amazon, I think it was. And they looked at all these companies, and all of these companies at the 8-year mark had a book value of about 50 times. Tesla, 500. So, and look, I think it's a great example. I think, do people think they're buying when they buy Tesla stock, they're getting access to SpaceX or something? We've seen this time and again. In the US, I think people buy stocks. I remember it was a laundry company put the word Bitcoin in their name. Stock went up 500% in the space of a week.
Well, I think you're right, to be honest, because when you go back and you look at the amount of new accounts that were put on Robinhood last year during the pandemic, all retail investors, these are people that aren't doing their research. They're just buying companies they've heard of. And you're right. I mean, exactly right. Any company that might be attached to Elon in some manner or regard, they think, oh, I might be getting exposure to some of these other sort of niche R&D projects he's got, which are set to skyrocket, pun intended.
Yeah.
So it's a case where that might be why Tesla is so overvalued right now.
That's the only thing I can think of. I mean, they go through and analyse Tesla versus the biggest car manufacturer in the world, Toyota. And I can't remember the Toyota's numbers, but I know Tesla makes about 300,000 cars a year. Toyota's something like 15 or 20 million cars a year. Yet Tesla has a market cap of 3 times or 5 times of Toyota. So I'm still trying to work out how that, and that great saying, the market can remain irrational longer than you can remain solvent is a case in point with this. And whether something comes out that justifies the price, it sort of reminds me like the .com tech boom and tech bust. When that happened, there was, people were paying massive premiums for not a lot of substance, but if the substance catches up, then that's fine. But the question is it going to catch up to justify the premium?
Well, that's right. If the substance does catch up, I mean, it also means that, it's got to catch up quickly, and it also means that share price can't move too much more, if anything.
That's right.
You'd expect a bit of a conservative pullback on it, to be honest. But I mean, Tesla's just an easy example. We're just using Tesla as an example because it's been out in the news a fair bit, and
Elon agrees. Elon agrees. He tweeted last year the stock price is too high.
Yeah. And you just, you look at the fundamentals, and it's just an easy company to talk about. But I guess the US share market, it did rally so aggressively, and there is always concern that it's gone too high, too fast, and the fundamentals aren't there, and now it's being propped up.
This, I did quite a bit of reading over the Christmas break, and just trying to really, you and I both have been watching the market for a long time. We know where it should be and what it should be doing, and trying to just understand the technical reason why it is where it is. And essentially, there's so much liquidity and so much capital out there. It's put a floor under the market. Debt is cheap. And like we've always said when we do our webinars and seminars, averages are dangerous. And, if you put your feet in the oven and your head in the freezer, on average, your body's a good temperature. Same thing with the market right now. You've got some Goliaths, the Teslas, the Amazons, the Apples, the Alphabets of the world, who are skewing the numbers. That's because they've had just phenomenal performance. That doesn't mean all the other companies. So, when I've been talking to clients this year and they're saying, is the market overvalued? The answer is yes and no. Yes in an average sense, when you look at as an index, but no when you look at individual performance. It's amazing.
Narrow participation.
Yeah, exactly. And, I think you can chase the unicorns and chase the, just the Goliaths, or you can actually still focus on companies. I mean, one of the stocks in our portfolio, which has just been a bull terror, has been ARB, but that's justified because no one's traveling overseas. Everyone's putting a bull bar and a tow bar on the car and going out bush and towing a camper.
Going camping.
There are companies out there who are benefiting that aren't tech companies, that aren't, and that's the stuff I think from a thematic point of view, we try and focus on is,
key themes.
What are the good stories? What are the ones that they're not asking for a pound of flesh in terms of when you buy their stock. There's actually, there's a reason why, it's a sound investment decision. And I think that's really the story of the market right now. It's so fragmented. When you look at Qantas, clients say, we should put all our money into Qantas. It can't go broke. No, but it can go to $1, or it can go to 20 cents, or it can go to 10 cents. That's right. And you might be waiting the next 10 years for it to bounce back up again.
Yeah, that's right. And I mean, I suppose, a good segue would be, we've been talking about the US, let's have a quick chat about the US dollar and, all these currencies that are pegged to the US dollars. I mean, talking to quite a lot of clients now where, they're in those countries which, it's either held against a basket of different currencies or it's, pegged to the US dollar. They're wondering, crap, I should have, in hindsight, sent some money back home in September. Where's the US dollar heading? Well, they're just about to green light that another round of stimulus. So I suppose, what does that mean?
It's funny how, when there's a major event and people know where they were when Princess Di died and when, all these different events happen.
Yeah,
so many people I've talked to in the last 6 months to Australian expats in the UAE and Dubai, they know where they were when the Australian dollar hit 56 cents to the US dollar, because they're kicking themselves down like, I was here doing this, I'll forget my phone, I should have done this, and anyway. Look, there's a couple of reasons why the US or the Australian dollar is where it is. The US dollar is incredibly weak. There's 18% more US dollars in the market right now than there was back in March. Combined with the fact that you've got now Biden coming in, looking at issuing more stimulus, more cash, more flooding the market. And then you've also got very strong commodity prices. Iron ore prices and those sort of things are holding us up as well too. So to me, for the short term, I can't see the Australian dollar going down. Which is causing a lot of frustration, for people trying to repatriate assets back to Australia. And, when we talk to clients, we always talk about the key risks, and one of those risks is currency risk. And this is why, taking a very unemotional, pragmatic approach to repatriating assets works. When the dollar was at 70 cents only a couple of months ago, at that time, you would not have wanted to transfer that money. You think, oh, it's too expensive, it's too expensive. Now you look like a genius if you transfer it at 70 cents, because now it's 76, 77, 78. So it's a great example of, and why we hold assets in different currencies. If you look at a US dollar basis of, performance, the Australian dollar assets have gone gangbusters, because the Australian equity market's up combined with the Australian dollars up. And there will come a time when that will flip around. And that's part of good asset allocation, and that's part of, it doesn't happen at the speed of, light, but more at the speed of paint drying. You start to readjust your equity bias and your currency bias. But, it is a great example of why, a lot of people think, I don't want to hold Australian dollars and I don't want to hold money in Australia. Now you're killing it if you do.
Yeah, absolutely. And I think, you touch on a very important point there about currency risk, and why sometimes, or why if we are going to be repatriating, retiring in Australia, or returning to Australia, whether it's 3 years, 5 years, 10 years, repatriating funds or excess surplus back to Australia in that ad hoc manner, you're essentially using dollar cost averaging compared to someone that might have a US IRA, 401k, maybe just US dollar cash. Now they're going, crap, do I wait another 5 years until the Australian dollar might be back down at 72, 73 cents, or do I, just bite the bullet, do it now, because that's part of my goals. I want to retire. I want to set up an income stream. So, sticking to that dollar cost averaging scenario.
And then they run the risk too, if they do return to Australia and leave the dollars in US dollars because the currency is not favourable, the cost basis for that currency starts on the day that they become a resident. They get a currency. They end up paying capital gains tax on the currency gain.
Exactly. Yep, exactly. So, and there's no way you can sort of avoid that either. It's just, we'll bite the bullet. But now you're creating a scenario where foreign currency gain is going to be inherited. That's a taxable event. That's a CGT event, capital gains tax event. Have to report that. So was it worth it in the end?
No, and it's all avoidable. That's the frustrating thing, and I think that, to me, I talk to clients when they're managing their assets. It's like project management. Break it down into segments, and you do different things at different times. So while you're overseas, you are repatriating money back to Australia. So when it comes time to return to Australia, you're not hoping, betting that the currency is in your favour. Your nest egg's there waiting for you, but also too, you're not opening yourself up to capital gains because the money's there in Australian dollars already. So it's that, finding that balance between the two.
Absolutely, absolutely. And I suppose, some of the key themes that I've sort of seen in the last few months, a lot of it has been around repatriation considerations, because a lot of people have been made retrenched, and now it's a case where they're sort of jumbling a few eggs, trying to work out, okay, well, how do I get my assets home? How do I get it in the most tax efficient manner? Is the ATO going to tax me on that? So those have been some really common themes. Okay, if I leave my share portfolio in the US, how's that going to be taxed? If I'm bringing back a large piece of capital, which is just cash, how's that going to be taxed on entry? When are the right time to transfer funds? Do I wait for the currency? So, well, currency's doing what it's doing right now. It's not really slowing down, especially for the strength of the Australian dollar. So it's the case where you do it now, or you bite the bullet and you wait a few years, like we just discussed.
Yeah, I think you're spot on. To me, it's managing your assets as an expat. It's like trying to hit a target that's around the corner that you can't see, but you've got to put the things in place in the build up to that point until you can see it.
Yeah.
and you can anticipate certain pain points. You can anticipate that the currency may be for or against you. You can anticipate that there'll be capital gains tax if you do something in a certain time. So to as you know, when we sit down with clients, it's a matter of, okay, how do we remove the risks? How do we decentralize the management of your assets so that it provides you choice? It provides you with that flexibility, as opposed to, if you don't do this now, even though you don't like the price, you get paid this tax. People will do it, but they're not getting the best result.
Yeah, absolutely. And I think probably a really key theme I've seen is actually these foreign pensions, or sort of,
Yep.
I wouldn't call them a foreign pension, not necessarily in the US, but other areas, especially through Asia. When we have a foreign pension fund, it might be a provident fund of some sort, but the fact that we can access it, we can still draw down it, we can withdraw it in full as a lump sum. Common ones are usually out in Isle of Man and those sort of tax-free realms, which
Yep.
they're not treated as a foreign pension by the ATO at all. It's common treatment as a foreign investment trust, 98B, I believe.
Yep.
99B, 98B.
99B.
Yeah, 99B. And there's obviously a portion there which is made up of capital contributions. There's a portion there which is investment earnings. If we're able to pull that out, send it back, whilst we're a non-resident, and ideally we don't resume our residency until a new financial year. That's the best case scenario. Absolutely.
It is.
There's a clear line being drawn in the sand there as Brett, you put it, demarcation, and therefore when we return in July, it's not going to be taxed at all. In the other scenario, a private ruling might be needed to make sure that the ATO doesn't want to tax the growth.
Yep. And look, I think also too, we're fortunate, and it's just all timing, and if you ask the government, they meant this, and but I don't think they did. But there are recent changes to super that do enable us to soften the blow when there is a capital gains tax event, using a couple of strategies that were only available to us in the last 2 years. So it has been quite fortuitous. I know both of us have been using these quite extensively and trying to mitigate capital gains tax events because it really works. And you get a win-win situation where you're funding a retirement and you're also reducing your tax liability. So it's not like money gone to the wind. But yeah, more of this needs to be done. I think that's the biggest thing. People are just sort of blindly just going, okay, well, that's it. Not always the case.
No, absolutely. And I think probably another thing with everything that's happened in the last 12 months with people being forced home is it has obviously forced them to put their head up. And I had obviously a new individual that's engaged us for some tax planning advice, but because they've been made retrenched, they also haven't lodged a tax return in Australia for the last 8 years. But, they've had a property and they just assumed, no tax return was obviously needed to be lodged, but it's been rented. I think on their scenario, they're quite lucky where it might be at a bit of an income loss each year. But I guess if it was at a positively geared scenario, they'd have a fair bit of tax, and then that tax is going to eat into their savings. They might be living off those savings for the next few months until they find a role, which, a common, I suppose, item that we always raise is not sticking your head in the sand and just assuming. Make sure you're up to date.
You've hit the nail on the head as always. To me, everyone I meet who's behind in their taxes is never an intention to be behind their taxes. What happens is they forget the first year, second year comes by, and then the third year, they're so fearful that something really bad's going to happen that they just don't. And then sometimes you can fast forward 10 years of no returns. And, as you know, the first thing we ask them is, well, do you put your hand in your pocket for the properties? And most of them say, yeah. It's like, well, so you're not making any profits. There's no positive cash flow. In actual fact, you're probably accruing credits. And you see that look of relief on their face. It's like, okay, well, now we have to go and, put it all together. There will be penalty charges and those sort of things. Sometimes you get those waived. Sometimes you can get those benefits. But you know what? It's not the end of the world. Certainly if you're generating $100,000 a year in positive cash flow and not declaring it, that's a different story.
That's right. And I think, as you said before, credits, income losses that just keep accruing each year. I mean, you've got to think about it from a sort of tax point of view, an asset point of view. Those losses that you're accruing, that's a tax asset. So that's something you can use in the future, offset, a capital gain that might be taxable. I need to sell a property, okay, that's great, but you've got 3 or 4 years worth of income tax returns. So, you need to get them sorted so you have an idea of any potential CGT you might be up for. It's all part of the sort of holistic planning sort of process that you need to take as part of your, your strategy or your exit strategy.
Yep.
So just remember that, if you're accruing losses or you're unsure, you're probably missing out on knowing whether you've got a tax asset there or a tax payable. Very important.
Look, it is, and I think that's the biggest thing is you can't plan unless you know the hard facts. To me, we meet a lot of people who their plans are too fluid. So it's like trying to throw a dart at a moving train. You're not sure exactly where it's going to hit. Whereas if that train's stable, you can tell I'm going to hit that carriage right there. And that's what good financial planning is all about. It's a matter of demarcating and structuring and aiming for a target with quantifiable, facts, as opposed to, we might do this, we might do that, we might spend this, might do that. I'm not sure whether we got a positive or negative cash flow. You can't manage assets like that. And one of the positives to come out of COVID, as you exactly say, is people are now starting to go, we've got all of this. I'm not sure whether it's going to get us to where we need to get it, but, we need to start putting a bit of accountability behind this. And I think what we do and what we bring to the table is we put meat on the bones. People inherently know what to do. They know to save. They know to accumulate assets. But whether they're doing it the right way as a non-resident, which is completely different to as a resident, or whether they're doing it in the most efficient way. People quite often get sold products. The UAE here is rife with them. They get sold these Isle of Man bonds by the who's who of the community. And, for those who are into it for a certain amount of time, all I can recommend is I hope you get your money back. That's a good result, which is crazy for 10 years just to get your money back. And they'll sell them at tax-free and stuff. Well, you got to make money to be, pay tax. These things don't make money. The fees are that high. Even if you were in the United States or Australia, very high tax jurisdictions, you still wouldn't make money. You wouldn't pay tax. So, and that's, I think people are starting to wisen up to that now. They're actually, rather than focusing on the lifestyle and the careers, they're now saying, well, we need to start to make sure that we've got some money coming in the bank as well too.
Well, that's right. I think obviously, making your money work a bit harder for you while you are an expat, if you're lucky to be in that position where, you're building up surplus cash flow, cash savings, and you're just unsure of what you can do with it. I mean, I suppose a lot of questions that I still get is, can I send money back to Australia? Can I contribute to super? So we're sitting on cash because we didn't think we could. We thought it'd be, taxed on, or I suppose the entry back into Australian bank account. It's still to this day, I don't know why, but I keep getting asked the $10,000 question about transfers. Oh gosh, I just don't know where it's hidden in those online Australian expat Facebook forums or whatever it is.
There is no 10,000 rule. There's no 10,000 rule. Like if you're carrying cash into the country on a plane, yes. If you're depositing cash into Australian bank, yes. But everything else, just ignore it.
And I mean, regardless, every transaction's picked up anyway. And 10K, it's something that always gets mentioned on the initial inquiries. But you can send back 50,000. You can spend back 100,000. If you're going to send money back, do it in the most sort of cost-efficient manner. Use a currency platform. Don't just go bank to bank. If you're in a unique country where the currency is considered exotic, then go into your main bank branch and see what they can do for you based on transferring. Because a lot of the time, those currency platforms won't have that currency available.
Yeah, no, we hear that all the time, and there are other ways around it too that we're sort of learning more, and I think as the world's opening up more, it's becoming a little bit easier, but certainly you need to take ownership of your money. That's one thing COVID has taught everyone, even those who've retained their job and haven't had the stress of, being without work. It's just shown how easily things can be taken away unless you're planning for the future. Airline pilots are a classic case in point here in the UAE. For the last 30 years, they've had a very good run of being in demand and being paid well for their services. If a particular country or an airline wasn't going well, they just move. Show me a job where they can't move anywhere in the world now to find work. So, that's a great example of, why airline pilots, and not just airline pilots, but anyone needs to put money away and plan for the future, both in terms of retirement, but also what if scenarios. And
that's absolutely right.
COVID's a big what if.
Yeah, I think when you reflect on sort of pilots, aviation as an industry, the amount of restructuring that's been going on, as we know, they used to get these great expat packages, allowances, all those sort of things. I think one that I've seen a fair bit is over in Hong Kong with Cathay. That was heavily voiced, but obviously you would have seen a lot that's been going over in the Emirates as well. But just no longer having these kind of great allowances dumped on them, and it's sort of making a lot of pilots question, is it worth it anymore? Should I just head back to Australia and even consider a career change? I know I've got 3 clients which are considering a career change right now. One's going to go back and do their masters. Another one's considering another industry that they may look in delving into, and obviously not planning for that as well.
Yep. Yeah. Look, and I've with a dad who's a former airline pilot, I've set up the cockpit in the good old days when you get into the jump seat. Pilots are always talking about what they would rather be doing. Not all of them. Some of them are very much wedded to the job and love it. But yeah, it is going to force a lot of people to have those hard conversations.
While things are improving, it's going to be a better year than last year. It could be a year that a lot of expats do start to reflect on their finances and think, okay, maybe it is time.
I think it's good. I mean, it's a good thing to do because, as I said, people inherently know what to do. But what I find is they don't know where it's going to take them. And it can sometimes lead you into a false sense of security. Oh, yeah, I'm saving this much a month. I'm good. But when you model that out and you show them what that number would get them to, and they go, okay, champagne taste on a beer budget sort of thing. So, that's I think it's always important to have that accountability just to yourself and just to your family and say, look, to me, 2021, I just need to, put that meat on the bones. I need to see where, by continuing down this path, where it's going to go. And if you don't like it, you need to change.
Yeah, absolutely. And I suppose we do these expat chats for our expats. We want to know what you guys want to know. We want you guys to set the tone, set the conversation topics, because we'll talk your ears off about it. So I guess a bit of a call to action, if you will. If you guys want us to talk about things on these expat chats, just send us an email, info@atlaswealth.com, what you want to hear. We'll pull it apart, whatever it might be.
And this will be also uploaded as well on the podcast, Facebook, YouTube, everywhere. So comment in the fields below as well too. We read those. If you want to tag us on Twitter at Atlas MGMT, Atlas Wealth MGMT, I should say. And we follow all the channels. So certainly we're here for you guys. We want to be as useful as possible, and that can only be achieved if we're talking about topics that you care about. So one last thing too, James, I would love to, if everyone, are on the podcast channels, rating and reviewing us would be sensational. We do see when people go and do it, we do get more exposure. We are able to talk to a lot more expats. We are able to educate a lot more expats. So the more people that do give us a rating and review, guys, we'd love you ever for that.
Absolutely. Couldn't have asked for more.
So, right, mate. Well, I know we've both just got busy days ahead, so I'll let you get back to it in Oz to wind up your day, and we'll get things started on here. And, mate, we'll see you on the next episode.
Absolutely. Thanks, Brett. Thanks for your time. Thanks, guys.
Thanks, mate. Take care.